Next, I wanted to introduce the man that made today happen, Alan Haig, our president and founder at Haig Partners, and he's going to go over the dealership buy-sell update. And for those of you that don't know me, I'm Derek Garber with Haig Partners. I'm in our Florida office and work primarily on the East Coast.
So while our IT team is hopefully taking care of that, I neglected earlier to thank Ally for being our sponsor this year. And when we started the idea of this conference, we weren't sure if anyone would come. So we didn't want to extend a lot of requests for sponsorships. In fact, we didn't want to have a lot of non-auto dealers in the room because I feel like the conferences are for auto dealers and it shouldn't be full of vendors, which we're a vendor. Turns out I'm supposed to load the next presentation. But we thought Ally would be an ideal partner for this conference because they sponsor a lot of entrepreneurs. I mean, in their name, Ally, it's not just a word. I think it is, in some ways, what they are. They're an ally to the dealer in terms of sponsoring growth. And we regularly see leading consolidators using Ally to help them finance acquisitions, capital projects, et cetera. So we've had the good fortune to get to know some of the teammates at Ally whom we didn't know before. But I do recommend for the folks in this room, if you're not an Ally customer, I think there are 10 teammates from Ally in the room today. Dan, is that right? Mr. Antonelli, does that sound about right? So if you don't know Dan, he's in the back corner. He can direct you to the person that would be covering your region of the country. But we regularly see Ally as one of the most supportive of entrepreneurs and their plans for growth. So in my presentation, I'm going to ask for questions along the way. I like to have a lot of interaction with the audience. To me, it's make sure that we're addressing the questions that you have instead of the points that I may want to make. So please, at any time, raise your hand, shout out a question. If you disagree with something, that's even better. We can have a little discussion about it. You can download this presentation or request it later. We'll send it to you. There's nothing on here that is going to be secret, so to speak. These are the topics for today. We're going to go over a little bit of what's going on with dealership performance because dealership performance and M&A are directly correlated. The better stores do, the more M&A, and then the obverse. We're going to discuss some of the key buy-sell trends that we're seeing in the marketplace. We're going to talk about what we see going on with consolidation in our industry and how you can secure your future. So first, let's look at what's going on at auto retail. The average gross profit per new vehicle absolutely spiked during COVID. There wasn't enough supply and there was a lot of money. And that was a great reputation for high profits per new vehicle at your dealerships. I remember speaking with a public company CEO. We were selling him a group of stores in South Florida. Included in that group are some Hyundai and Kia stores that used to get about $800 gross profit per new unit. And then that had spiked to about $5,000 of gross profit per new unit. And that CEO said, Alan, how much longer do these margins last? I can't pay your client based upon these profits because they're inflated. And I answered, well, I think the manufacturers have learned that less is more and that they make more money when they're producing and advertising and supporting and incentivizing fewer units. And he said, BS, in a very loud kind of short term. And he's largely right, but not completely. So if you look at where we are since COVID, the average gross profit on new vehicles is still 22% higher than it was even after adjusting for inflation. So the new vehicle department has become a better profit center since COVID. F&I tracks the value of a new vehicle, right? You're financing a more expensive vehicle. You're insuring a more expensive vehicle. We're now up 14% more in F&I profits after factoring in inflation. Fixed operations. That's been, maybe not unsurprisingly, a big profit center when there are fewer units that are made. People have to invest in their existing cars to keep them serviceable. But also we've seen a massive number of recalls. Any Ford dealers in the room? God bless Ford recalls. Is that fair to say? Yeah. And also the vehicles are much more complicated to repair than they used to be. So, for Ford customers, it's not nice for them to keep on coming back to the store. But this low to high single-digit growth in fixed operations, which is the most profitable part of our business, has been another driving force in dealership profits and why these dealerships are so desirable. If we look at netting out all of the different changes in gross profits and expenses, because expenses have gone up too, it's not all rosy. The average profits for dealerships, franchise dealerships, for the third quarter of last year was about double what it was, including factoring in inflation from 2019 to 2025. So even though we've had that decline in front-end gross profits on new, higher costs, we're still sitting, if you just look at the third quarter, at double the level of profitability as where dealerships were pre-COVID. If we look back at a full 12 months, profits per dealership, and this is for the publicly traded auto retailers, and their stores include a mix of domestic, import, and luxury. So if your numbers are different, you might be higher than these if you have Mercedes stores. You might be lower than these if you have Stellantis stores. But the average profit through the last 12 months ending third quarter 2025 was $4.3 million a store. Pre-COVID, 2019, we're up 78% after inflation. So it's still pretty darn good. I know we wish the old COVID days would be back, but the question is, are we going to sustain this level of profits? How are you planning for the future? I think it depends a little bit upon your franchise, your market, et cetera. So if we look at what the future is, and I've learned that's a dangerous thing to predict the future, so we often ask others what they think. And over the last 6 months, Haig Partners has been doing a poll and asking respondents, we do this through LinkedIn, and the respondents are a mixture of dealers, general managers, other people that work in the industry. And this is what they've been saying. And it's varied a lot per month. So this may not be the most broadest, most scientific poll, but it gives you a general sense of what others in the industry think. And we're now at a point where about half the market thinks that profits are going to decline, and about half thinks it's going to be the same or better. Anybody have any strong opinions about the future? This feels about right to me. We've been expecting a bigger decline in profits than what we've seen, but we get some nice little bumps that help our industry. I think in the first quarter, John, I believe you and Aaron mentioned this, we're going to have a significant amount of tax refunds coming to our customers compared to last year. Has anybody noticed that uptick yet? Anybody coming in with their refund checks? Yeah? Okay. So that might be one of the positive little bumps that we haven't factored in. In terms of the key trends that we're seeing, we'll talk a little bit about the presidential election of 2024. We saw that slow our business. We're going to talk a little bit about how franchise values have gone in different directions depending upon what franchise you have. We're going to talk about the impact of killing CARB, which I think is, Mike just mentioned it. I think it's understated how significant that change was, because it was almost doomsday coming for many dealers. We're going to talk about market timing. Is it a seller's market? Is it a buyer's market? Where are we in that cycle? And then a shift that we've seen over the last 5 years, and that dealers increasingly prefer larger metro stores compared to smaller rural stores. The number of dealerships that traded hands before COVID averaged around 350 or 400 per year. As dealership profits spiked, so did M&A. And I think there are a few reasons for that. One is, if you were a dealer that was thinking about retirement and you experienced COVID and your dealership profits tripled, you might say, well, I needed X number of dollars for me to retire. That time has come now, so I'm going to sell my dealerships now, maybe sooner than I would have otherwise. There's also a massive amount of money looking to spend, looking to invest. So the dealership values went up significantly during this time too. So you had more demand and you had a greater supply of willing sellers. So that's what we saw happen in 2001 or 21 and 22. This year it dropped. It dropped from about 20% from last year. And I think it was a combination of factors that led to that decline. I think one was the presidential election. If you were an owner and you're thinking about selling your stores, you'd like to know what your tax rate's going to be when you sell. right? And we didn't know if it was going to be a Democratic administration that might be a higher tax rate or a Republican administration that might be a lower tax rate. And if you were a buyer, you might want to know too what's happening with certain legislation, certain regulations about the future auto dealerships, like CARB. Would you want to buy a Ford dealership in Southern California if CARB was coming, when they make all their profit on F-150s and 250s and Expeditions and Explorers, and there really weren't any electric vehicle equivalents? So we saw a lot of transactions slow, I would say, in 2025 as buyers evaluated the environment. Do I want to proceed? And sellers evaluated the environment. Do I want to sell now? Is this a good time? So the number of transactions we worked on in 2025 was about the same they worked on in 2024. They just didn't close at the same rate. Our pipeline is probably as robust as it's ever been. So we're anticipating a strong year in 2026 in terms of M&A. And partly it's because it tracks the new vehicle profits, which we talked about are still really high. In fact, they're growing. And the demand for vehicles or demand for dealerships, I think, is high and growing too. I mean, look in this room. This room is full of people. It's a first-year conference. Everybody here is interested in growth. This is not a divestment seminar, about how to sell. This is really people here about how to grow. The public retailers, if you consider them to be smart money, they have a number of ways that they can invest their capital. They can invest it in stock buybacks. They could invest it in dividends. They can invest it in CapEx, expand their dealerships. You can see here over the years where they put their capital is varied. Before the pandemic, the public companies were spending about $800 million a year on buying auto dealerships in the U.S. 2021, we had this massive spike where there's about $9 billion of value that went from the public companies to private sellers. Since then, we've been back in that $1.5 to $2 billion spending range on domestic auto acquisitions. Through the third quarter of 2025, we're going to be about double that. And some of it is Asbury's acquisition of Herb Chambers Group, which is a significant acquisition and doubled the spending for everyone else. But if you look at this chart that shows a number of the recent acquisition activity we've seen around the country, everybody's in the market. Almost all the major consolidators. On the West Coast, we've seen Lithia acquiring Porsche stores, Audi stores, Hyundai stores. Fletcher Jones sold some stores in Chicago and bought a BMW store that we represented. Jason Crouch from our team represented the owner there. I believe Sonic. John, are you in the room? John Russ? John Russ helped lead the acquisition of 4 Land Rover stores, Jaguar Land Rover stores in California. They've now become the number 1 Land Rover dealer in the world. You have Ben Keating, a large dealer in Texas, acquired a significant platform. I think this deal is closing this week. My friends from Ally, is that correct? That we don't know the exact purchase price, but we think it's in the $400 million range. So he's an individual. He's not backed by private equity, to my knowledge. You have AutoNation that's in the market. They bought the Mercedes and Audi stores that Fletcher Jones sold in Chicago. They bought a Toyota store north of Baltimore. You have Group 1. I know I think Pete and some of the attorneys are here from Group 1, Pete the Longchamps. They bought a Mercedes store in Atlanta, and they bought a Lexus and Acura group in Fort Myers. The Penske organization has spent about $1 billion in the last 120 days or so. They acquired Longo, Toyota, and Lexus stores, which had 2 Lexus stores, one in Northern California, one in Southern California. They bought Longo Toyota, which was in Southern California, and another one in, I believe it's Prosper, Texas, outside of Dallas. Just last week, we think they closed on the acquisition of 2 Lexus stores in Orlando. They're massive stores. And I think that transaction set the high mark for Lexus for the time being. I didn't mention Asbury yet. They acquired Herb Chambers Group. They're digesting that. And when they do, I believe they'll be looking for growth as well. And then there's another transaction here that also happened last month. Are the Weiler folks in the room? I saw them earlier yesterday checking in. Congratulate them on the purchase of Midwestern Auto Group. I believe that was about $250 million in goodwill. So if you look at these deals that are happening, these are transactions that are significant, and they're all across the country, and they are, to me, a reflection of confidence in these markets and these brands. Now, the Chambers Group was diversified. They had a lot of different franchises in there. But if you look at the rest of this, I mean, there's a lot of concentration on strong brands, whether it's luxury or Toyota, etc., Subaru. Blue sky values. Blue sky value is a reflection of the buyer's perception of future earnings. And we've seen blue sky value peak in 2022, 2023, when the profits per store, you might recall, were more than triple what they were pre-COVID. But we haven't seen them diminish much. As we move away from COVID, dealers are still finding a way to generate a significant amount of profit. And we saw where it's coming from. A lot of it's coming from fixed ops or used or F&I. So high earnings matched with confident dealers, confident buyers, reflects high multiple and high earnings. Blue sky values remain strong. But franchise performance is uneven. Do we have any Nissan dealers in the room? Okay. Any Stellantis dealers in the room? A lot. Volkswagen dealers in the room? These have been brands that have been challenging. And we're talking about here the change in new vehicle sales per rooftop over the last 6 years. Cadillac was surprising to me. That I don't think about Cadillac as being a star performer in the last 6 years. They really are down to one product that sells really, really well, the Escalade. But General Motors did a good thing for dealers in that they went out and they acquired or paid a lot of dealers to close their doors. And that was, I think, a very smart move. It reduced the dealer count. It allowed the remaining Cadillac dealers to sell more, have nicer facilities, have a better staff, increase the value of that franchise. So unlike some other manufacturers, General Motors have been out there making things better for their Cadillac dealers and also for their Buick and GMC dealers, because a lot of Buick points went away. We haven't been surprised by Mazda. We've been tracking that brand for quite a while. They also reduced their dealer count, and they came up with better products. I mean, Mazda to me is somewhere in between a midline brand and a luxury brand. If you haven't been to a Mazda dealership, I encourage you to visit one. The design to me is as nice as any luxury store. And they're getting to the same point in sales per location as Kia and Hyundai are, still below Subaru, Honda, Toyota. The other brands, again, we had 6 years of population growth in this country, but not 6 years of production growth. So John mentioned before this mismatch between the SAR and that lack of production we had during COVID era. But low to mid single digits is kind of on the weaker side of it, but we still see strong profits coming out of Chevy stores, Ford stores, etc. The most challenged brands have been Stellantis, that, in our opinion, made the mistake of pushing up their prices to dealers far too much and maybe not updating their product portfolio very much. Nissan not having vehicles that are as competitive as they could be, perhaps, in the major segments, overproducing, still maybe selling too much into the rental car fleet, not having great lease programs. There are a number of factors that have contributed to some frustration in the Nissan category. And these new vehicle sales are critical to your dealerships, as you know, because they drive everything else. You know, a customer comes in, they're going to trade in a car to buy a new one. That gives you a nice trade for a used car lot. When you get the trade, you're going to run that through your shops. You're going to get the reconditioning work. So as new vehicle sales drop, so do profits and so do franchise value. So if we look at the value of a Nissan store today compared to a Toyota store, there's always been a difference. But I'm not sure if there's ever been a greater difference than there is today. Any opinions about these change in sales per location? Anybody have Mazda? What's your opinion of what's happened in the last 6 years? Positive.
Yeah, they're going in the right direction. Very easy. I think there's a lot.
How about Kia? Any Kia dealers in the room today? What's your opinion? What's your experience been? Same. Okay. We have Honda speaking later, so we're going to let him explain all the attractive things that are coming to Honda. Honda's been an amazing franchise for dealers. They didn't produce as much during the pandemic. They had a number of reasons for that. Not my position to comment on it. Almost doesn't matter. What really matters now is the future. But we see Honda on the right side of the scale at 9% change in sales per dealership. That's positive, not as positive as some of the other brands. And I think that has to do more with the availability of production versus the demand for the product. There's a big difference. Anybody have Infiniti? I know some of you do. You might not want to own up to it, but I know some of you do. I would say Infiniti may be the hardest franchise in the market to sell today because of the significant loss of volume in that franchise. And I think some dealers have given up. They'll talk about their product plans for the future and how that can recover. And I believe it will recover. But certainly today, it's a great challenge. So we talk about how new vehicle volumes drive franchise value. You've seen our slide before when we talk about blue sky multiples per franchise. And there are big variations on these multiples. If you're an underperforming store, you're going to get a higher multiple than what we have here. If you're an overperforming store, you might get a lower multiple. If you're in a low tax, high growth state like Florida or Texas, you're going to get a premium. If you're in a slow growth, high tax state, it might be a discount. If you have a facility project that's just image only and it's not going to improve your sales or your service, you might get a little discount either on your blue sky or on your real estate. If you're a Subaru store and you're expanding your service because you're under, you might get a premium to this because the buyer's going to see more value in the future. So there are all types of things that impact blue sky value. Anybody have any thoughts about these multiples of any are high or low? Who bought a Kia store this year in 2025? All right, Mr. Wattar, do you think that we have Kia fairly valued?
I don't think so. I think Kia is probably one of the best. Yes, it's a good fantastic brand. Very reasonable arrangement the dealer, they buy it. And the same time,
All right, so if you couldn't hear Nasser, who owns Trophy Automotive Dealership Group based in Southern California, he thinks Kia is one of the best brands to own because the management is easy to deal with, the product is superior. Something else that we like about Kia is that if you're a leading dealer, they will give you more product. It's very difficult to get more product with General Motors, with Toyota Lexus, but with Kia, if they're leading dealers, you can really take a store and significantly transform its volume within a short amount of time. That's been what we've seen. Did I miss price positioning?
plus the look at each region and drive development.
Okay, so price, and they regionalize their incentive programs, marketing, dealer support. Any other franchise that people think we have mismarked here? Mr. Walzer, I see you back there. What do you think? Do we have this correct? Do you see any brands that we have on here that you think are under or overvalued?
When I get called to grower, number are always higher. So, I guess what I would like to say to everybody in this room is stay away from the franchises that I like. So, don't buy a Mazda store, that sort of thing. But no, I don't know, Alan. You're the expert. I'm not. But we get contacted from a lot of brokers, as I'm sure everybody in this room does, and it always seems to me that the pricing is quite a bit higher than the reported multiples. So, I'm not sure why that is. We might be just getting the wrong phone calls.
Eric, can we change this chart and move everything up 1.5 turns? Is that possible still?
You got it.
All right. Other people have opinions about these multiples. Yes, sir.
I just find it interesting too. The multiples, I never really agree with these things that you introduce because even if the store you want to buy is losing money year after year, month after month, you have to be able to pay up for the pleasure of doing business with it. It never makes sense.
That's correct. I agree with you that even money-losing stores have got positive franchise value. I've only seen a couple times in my situation where there's a super high rent factor where a dealer will sometimes have to subsidize the rent and get no blue sky to get out. But these multiples are based upon, I would call, an average performing store for this franchise. So if you look at the far right side of the scale, most Infinity stores are not profitable today. Most standalone Lincoln stores are not profitable today. We have those in gray because that represents a average dollar value. So the scale on the right is 0 to 2 million in franchise value for each of those brands, and that's what we've been seeing recently. So underperforming stores, the multiples don't apply. Agreed. Isam.
Simple system I various graduates is how solid capital base is. What are the major longevity ESOP? It is not is the product that very easy. Their relationship
really support them with being able to buy very deep. A brand like Kia and their relationship with Hyundai Capital and KMF allows them to buy very deep, and you're able to move a lot more vehicles.
So the strength of the captive of that OEM drives franchise value. Agreed. You look at Toyota and Lexus, you look at Honda, they do an excellent job supporting their dealers, whether it's on sales or leasing. Any other dealers want to comment on these multiples? Nasser.
What I'd like to see naked will boxes on each carrier mark with miscord. The concentration also. I mean, I think just like the OEMs now are really thinking about how do they tackle the market in each area. Because, for example, California on EV before was different than Florida, and so on. So the valuation of franchises in California is different than, for example, in Texas or Arizona or, and so on. So this would be more significant, I think, if this is taken into consideration in your analysis.
It's true. The location matters. A Ford store in Dallas, Texas is going to sell for a lot more than what we have quoted here. And a Mercedes store in Southern California will be at or top or above the top of our range. Someone else had a comment. Question. Okay, back there. Hey, somehow it got cut off our scale. I think Mitsubishi's made some really good products over the years, but the consistency has been uneven. The support that they can provide to their dealers has been uneven. And we often see somebody get hold of a Mitsubishi store and then sell it pretty quickly because it hasn't worked for them. So some dealers, I think, make a good living with Mitsubishi, particularly if they're good used vehicle retailers. But as a standalone franchise, I'm not sure it generates enough revenue per location to be highly profitable.
I got a question about am I better off buying one Mazda store than a Porsche store when I'm looking only on the
So the question is, am I better buying one Porsche store or two Mazda stores if you said return on investment, you said? Great question. Some of the brands that we see on the far right side of the scale are high multiples, not because they're growing so fast, but because they're safe and they're secure and the dealer can count on getting a lot of support from their OEM. They're viewed as a partner. Toyota and Lexus have, kind of long believe, but a lot of dealers believe those are the best partners. So those are lower risk franchises. They have broad product categories. They have excellent finance companies. They're reasonable in terms of the way they let dealers operate. So if I were looking for the highest ROI, I might buy a Ford store or a Chevy store if I'm a good truck retailer, because there are a lot of those franchises out there. And so it's hard for any one franchise to command a lot of blue sky because a buyer can go and shop among other locations in the market for that franchise. So if you're looking for a higher return on investment, in the near term, you choose Mazda over Toyota. And Mazda now has some support from Toyota, right? Mazda over Porsche. But Porsche has a brand that matters so much to its consumers. If you're a 911 guy and you want to try something different, you try a different 911. I don't think you're going to buy a Nissan GTR or a Mercedes AMG GT. So Porsche has such a loyal customer base that brand for decades is going to be profitable for you. You can just count on it. So it depends a little bit on you. Are you an emotional buyer? Is Todd Blue in this room today? If he were, he'd say, I'm just buying luxury. That's what I care. The other brands might be a higher return on investment. Is he here? All right. Okay. So he would, if I said, Todd, I've got a really nice Chevrolet opportunity available in your backyard, he's going to pass. If I say I have a nice Mercedes opportunity in your backyard, he may be the strongest bid in the room. So some of it's emotional. So as for, are you better off? What's your objective? If you want to have a high near-term return on investment, you choose Mazda. If you care about the product category, you want to retail it with your friends, you want to go on trips to Germany, you want to go to the concourse at Pebble Beach, you want to see the new products, you choose Porsche. You get a lower return, but you might get greater joy of ownership. Another question.
Is this thing on? There we go. So what are your thoughts on add backs? So you're talking about multiples, and all of us are used to looking at a statement, page 1, bottom right, take a look, multiply it times that. Pretty easy. And then we get with the brokers, and then they give us $1.5 million worth of add backs under the line, which I think at best 50% of them are real. And now I'm supposed to pay 8 times that if I'm looking at a BMW store. It seems a little. Has this changed recently? Because 10 years ago, I don't remember all of these add backs getting added in and then paying a multiple on top of that.
Well, I think our industry, and I say our industry, I'll say M&A advisors, brokers, whatever you want to call what we do. I believe it has enhanced franchise value for sellers. And I believe it has irritated some buyers who in the past, because years ago I used to be at AutoNation, my favorite position when I was in AutoNation buying a store was I was the only buyer in the room. And I looked at the statement and I made the seller an offer about what I wanted to offer. Once it became competitive, I, at AutoNation, had to pay more. And so hopefully the value that firms like ours are adding is looking at a dealer's statement says, oh, do you have any off income statement income? Well, yeah, I pack my service contracts and $500 per contract doesn't go into the store, it goes directly to me. To me, that's income being generated by the store. It's value that the next owner is going to receive. So they should know about that income and they should pay for it. If you have a piece of real estate, sometimes like in Florida or some places, people will have a low or a very high price on their real estate because it's another pack. The higher the rent is, the lower the net profit, the less they pay their general manager on that. That's an artificial rent. And to us, there should be a market rent, which today is about 7% of the value of the property. So the add backs that we're doing are really intended to show the actual cash flow that the previous owner had and is available for the new owner. Now, there's some other add backs that we've seen or heard about where you start to be like, maybe that's not something a buyer should pay on. If you say, well, I should have sold another 200 cars, but I didn't. But if I did, here's what I would have made. You got to pay me on that. That's not an add back, that's a projection. And that's up to the buyer to decide what they think they're going to make. So we see, and I'm going to ask my teammates, if we get a dealer statement, it's around 20% add back. Is that about right, guys? I'm going to look back in the room here. Roughly 20%. So if it's the statement's showing $5 million on profit, by the time we add back the dealer's salary, the packs, the reinsurance profits that go outside the dealership, it's around 20% add back. And I would say that every leading buyer has a CPA firm that digs into these add backs and they decide for themselves, yeah, that's legit or that's not. But for us to fluff up a seller's income statement, get bids, and then the diligence starts and the buyer says there's less profit here than what I thought, I'm cutting my price, that's that's bad advice for a firm like ours. So we really quote the add backs that we think are available to the buyer. Other questions on this topic or anything we talked about so far? Okay, let's talk about Nissan and Stellantis. We had the pleasure last year at our firm of representing a number of Stellantis dealers and Nissan dealers. And it was a challenge. You know, Nissan and Stellantis have always been maybe the two most variable of their categories, whether it's Stellantis for the domestic brands and Nissan for the midline import brands. So if you go back 2019, the combined number of dealerships for Nissan and Stellantis dealers were about 15% of the total franchises that existed. That's that little box in the check marks. But 21% of the dealerships sold in that year were Stellantis or Nissan. So they were overperforming maybe in a bad way pre-COVID. People were selling them at a higher rate than what they represented in the market. If you go forward through COVID, Nissan stores and Stellantis stores still made a lot of money during that time. But I think Stellantis store had something like 12 straight quarters. I can't remember how many years of sales decline Stellantis dealerships had. It was really hard on dealers, and they were increasingly frustrated. So as the frustration level increased, as hope diminished, the percentage of stores sold of Nissan and Stellantis stores skyrocketed. And last year, a third of the dealerships that sold were Nissan and Stellantis dealerships, and they only made up 16% of the market. So they're outperforming 2-to-1 in a bad way. And I think, obviously, whenever there's a sale, there's a purchase. So there's still plenty of people that believe there's going to be a turnaround at Stellantis, or even if there's not a massive turnaround, they can right-size the expense structure and still make money. And for Nissan, I think it's kind of the same category. that people were tired of losing market share, the challenges of being a Nissan dealer. So some people just gave up. And my guess is a lot of these stores that were sold were owned by larger groups, bigger consolidators that had 10, 20, 300 dealerships, and said, I'm kind of tired of the struggle. Let me take my capital out of this business and redeploy it into a business in which I get a better return. I don't have the people to put into that store anymore. And so I think a lot of these Nissan and Stellantis dealerships have traded to younger, hungrier dealers, some of whom are buying their first store or their second store. And I recall from my days at AutoNation, we have some AutoNation alumni in the room, Rick Ford and David Spizak. Second time that I was at AutoNation from 04 to 08, we bought 14 stores and we sold 56. And I remember saying to the guys buying the stores that we were selling that were losing money, what are you going to do here? These are, we're struggling. What's going to be different? And every one of them had a plan to improve the store. First thing I'm going to do is I'm going to replace the burned out lights in the lot so customers feel safe coming. I'm going to replace the burned out lights in your signs so people know what products you sell. I'm going to rip out the stained, dirty carpet, the entryway to your showroom so people feel like they're walking into a legitimate business. I'm going to fix the stained roof tiles, above the customers. I'm going to fix the broken urinals in the bathroom. But more importantly than that, I'm bringing in a general manager who's hungry, knows this area, knows the product, and is excited. They're going to bring in fresh inventory, fresh people, fresh marketing, etc. And we would see these stores that AutoNation struggled to make any money with, actually lost quite a lot of money with. Within 30 days, 60 days, 90 days, that store had doubled or tripled in volume. Has anybody bought a store that they turned around recently? What was your experience when you bought kind of a broken down store? What did you do differently than the previous owner? You brought your people in. Same product, same location, different people, different outcome. It's amazing how powerful people are in this business. You can't overstate that. So, let me ask the team or the group here. Maybe we could sell a dealership today, right now. We have a client who owns a Nissan dealership in an excellent market in the Southeast. He made over $7 million last year. He's got a facility that's worth less than $12 million. The return on the balances there is really favorable for a buyer. What's that worth? Somebody fit fixed coverage? Don't have that answer. but he's a very high net to sales dealer. I think he's over 7%. So he's like a Nissan whisperer. He knows that brand really, really well. Can I hear 15 million? Do I have a bid? You just raise your finger. 15. Do I have a 16? 16? Do I have 17? I'm not going to hold you to this. I'm just curious what people think the value of this business might be. Did you say 17? 17? And you get the fixed assets included in that? So this is a bit of a conundrum because this, to me, $7 million dealership is an excellent asset. And if this were Toyota, the blue sky would be over 70. So what is it for Nissan? Same amount of earnings, same location, same quality facility, different product, different supplier. So if you're interested in this dealership, we got to pay for this conference somehow, y'all. For other brands, there are too many Nissan stores today. There should be 1/3 fewer Nissan stores. Yeah. I don't think they have the money to go buy and close dealers the way that General Motors has done. And Ford is also quietly paying dealerships to close. Those are very... we heard about the Volkswagen meeting, how many dealers are very upset because they don't feel supported by Volkswagen. They almost feel, dissed, if you will. They're not supporting. But General Motors and Ford are quietly being good partners to their dealers, in my opinion. Not always, in all areas. Nissan probably would like to be better, but they're in a bit of distress, right? I mean, they sold their headquarters to raise cash. They're closing plants. They need to regroup and shrink. And I think that you're going to see Nissan stores close in certain markets where the buyer says, not enough volume here to be sustainable. I'm going to sell this property to somebody that wants to put a hotel or an apartment building. So for Toyota and Honda, it's a seller's market, if you will. If Nissan's a buyer's market, Honda, Toyota is a seller's market. And we did a little math. Over the last 3 years, there have been an average of 34 Toyota stores that sold nationwide. So the average dealer is holding on to their store for 34 years. So if you live in a market and I call you, or one of my teammates calls you, and we have a Honda dealership that we're representing, or a Toyota dealership you're representing, and you say to us, I don't love that location, I'm going to wait for the next one. I hope your kids remember that conversation, because you probably won't see another one in your lifetime that comes available in your market. Now, Los Angeles, big market, you might have several Toyota stores that sell a year, but not 10, not 5. Does this sound about right? Yeah. So they're not common assets, which is one reason why the blue sky values are so high, because when they come available, buyers compete to acquire them. California was, in my opinion, in all the CARB states, saved when our current administration abolished CARB. I don't even know how bad the performance would be at these dealerships if they had to sell all zero-emission vehicles by 2032. And look at the change in investment that's happening in California since CARB has been abolished. You have major private and public retailers that are investing literally billions into California now. They would not have done this last year. Jason Crouch, one of our managing directors based in Los Angeles, he and I are involved in the sale of a couple of platforms and small groups in Southern California. Early last year, we went to market with one group. We got some interest, but not very compelling interest, so we decided to wait. Same thing with the second group. And then when CARB was abolished, we remarketed, and the change in offers we got for Blue Sky was here on the screen. Significantly higher Blue Sky value when you remove the risk. We're having a challenge getting bids at all on some of these assets, and they were nice franchises, nice buildings, nice markets. People were just saying it's too much risk. I'll take my capital and go to Texas or Florida or Arizona or the Carolinas. With CARB gone, now a lot of that capital can stay in California, which is the number 5 economy in the world. The amount of AI, amount of wealth being generated by AI in Northern California, it's in the trillions. So you want to be a dealer in California if you don't have this existential risk. Is now the time to buy? I'll let you kind of go through all these on your own. But in my opinion, many of the risks that we had over the previous years are gone. Many of the unknowns about what's the future value or future performance of a business are gone. And the supply of dealerships, I think, is going to continue to be strong because the average age of a dealer has gone up since COVID. Another trend we're seeing is there's more competition for the bigger stores. Some folks have got the talent to turn around smaller, underperforming stores. Talent remains maybe the one item that's in shortest supply in our industry. Talented general managers who are capable of running a business with a lot of oversight for years on end. The bigger stores are more stable. You can attract better management. The customers will probably be more loyal to you. You have greater ability to cover your fixed costs. My friends at Ally in the room, would you all finance a new dealer today acquiring a Ford store, selling 30 new units a year in central Oklahoma? Is that a deal that you would take today? I don't see one of them raising their hands. So I think it's hard to get financing for smaller stores. So future consolidation, just have a couple minutes left here. Our business remains massively fragmented. I don't know of another industry where the top 150 groups comprise just about 25 or 30% of the number of dealerships that are outstanding. So still a huge amount of opportunity for folks that want to grow. Here are some examples of groups that have grown significantly over the past 10 years. Morgan Automotive Group, our friends in Florida, they've grown 387%. You can see, I don't know if Mark McClarty's in the room today. I think he was here earlier. His group has grown significantly. Lithia added 322 stores over 10 years. That's an incredible lift to accomplish that and still have the factories approve you. That's really a remarkable achievement. These dealerships, I refer to them as sticky assets. They're hard to get and they're hard to get rid of. So we just show this to show what's possible if there's a group that's committed to growth, how much they can transform their businesses within just a decade. Why should you buy these dealerships? In my opinion, it's a great use of cash. The return on a car dealership far exceeds what you can get in the stock market or paying down your floor plan. Diversification reduces risk. If you just have a Ford store and Ford takes a turn for the worse, which it has with the EV strategy, wouldn't it have been nice to have had a Mazda store next door that enjoyed a lot of growth during that time? Every franchise has its turn in the tub, is a phrase that a dealer friend of mine said. Scale, the bigger you get, the more of what you earn you should keep. And then I mentioned before talent. As you grow, there should be some new talent that comes in your organization. Anybody remember a dealer in Kentucky named Sam Swope? Anybody know Sam? He had a phrase I learned: when you're green, you're growing, and when you're ripe, you're rotting. And I think if you're out looking at acquisitions, you're going to continue to be green and keep growing. If you're not paying attention to your business, if you're not looking to grow, your processes age, your people age, perhaps you lose some of that competitive spirit. So I'm running out of time here. I'll just go through this quickly. There are different acquisition strategies that we see successful. Clicks and bricks. Does this look like something that someone would say today? Low-cost operator, technology, brands. Mike Jackson wrote this in 1999. Check out the annual report, the cover of the annual report, Clicks and Bricks. This is what Carvana is doing today. Carvana now owns 4 new car franchises. They started on the digital side. They're now on the brick side. Auto retailers started on the brick side. Now they're getting a digital side. You've got to be excellent, in my opinion, at both, because that's what the customers want. These consolidators are acquiring to get scale, to help reduce their costs and make them better competitors. They're using technology. We had Steve talk about how AI can transform your business from a 2.5% net to sales to maybe 4 or 5. And I would say the public companies do an excellent job, the large consolidators, on used, on fixed, and on F&I. They can deploy trainers, et cetera. They do a really good job in these departments. Sometimes they struggle on the new vehicle market share, but on these departments, they really kill it. Can only mega dealers survive? No. In my opinion, small dealers still have an excellent ability to outcompete the largest dealers because they can come down to talent. I think it's easier for an entrepreneur to retain a good employee, a talented employee, to groom them than it is for a public company that has 20,000 employees. You're more of a number to them versus, you probably know many of your employees by name. You know who they're married to. You know what sports their kids play. So I still think that small entrepreneurs can compete head-to-head with the largest companies and often win. Other acquisition strategies, the clicks and bricks at the local level. I don't know if the Flow family is in the room today. I encourage you to go to their website out of Winston-Salem, Greensboro. They're all about having multiple brands, multiple franchises, common brand, focus on local communities, focus on their employees. And they've got a stronger brand in the Greensboro, High Point, Winston-Salem area than any national consolidator does. Other folks are franchise focused. They just look at, I just want to buy a Toyota store. I'll buy a Toyota store anywhere in the country. I'm really good at Toyota. It doesn't matter what market. Some people are more luxury strategy. I mentioned Todd Blue before. He's not going to buy a Nissan store anywhere, even if I gave him that store I talked about before. But if there's a Mercedes store somewhere in the country, he's going to want to pursue it. And then we have folks that are operator focused. These would be the Wes Rydell Group, who's here with us today, where they're not buying a store unless they have the operator already selected and groomed and trained, and they're confident in that person's success. And when they do buy a store, he becomes a partner and one day the outright owner. So their growth strategy really is talent focused. AMSI, Terry Taylor, same model. I think Joe Sarah, same model. They are going to focus on the operator first and the brand or the location second. Everybody who wants to grow should start with an acquisition strategy. Sometimes we have folks call us and say, hey, we want to buy stores. And if I say what kind and where, and they don't have a clear answer, they just say, well, show me everything you have. Then the answer is, okay. And then we don't show them anything because it's our job to only focus on those that are most motivated to acquire the business that we're representing. But if you say, I'm interested in Honda dealerships in the Southeast that sell at least 150 new a month and have some upside performance, that's a pretty narrow focus. So when we have a client that matches that profile, that dealer is going to get a call from us, and we're going to show him that opportunity. Make your strategy clear. Don't keep it a secret. Tell everyone who supports you, they'll bring you opportunities. Tell us what you want. We'll bring you opportunities. And then as a buyer, you need to be credible to advisors. If you say, I want only Toyota, and I bring you 5 Toyota stores and you don't bid on one, I don't really view you as a credible buyer. I think you're a little bit of a tire kicker, and it's not right for me to show my clients' businesses to you if you're not serious about acquiring them. If you make an offer, a letter of intent, our client signs a letter of intent, and then you ghost that client, we're not coming back. Those things are harmful to the process. I mentioned I think it's smart that you're in this room today to be friends with folks like us. You mentioned every broker you see has all these ad backs. Maybe some of them aren't legitimate, but there's an increasing percentage of transactions that are handled by firms like ours because I think the value of this business has gone up so much that they deserve to have proper representation. So it's about 60% of the dealerships sold today are being sold through firms like ours. This is what we see, people evolving. Today, the average dealer's got about 2 stores. In our opinion, for them to really thrive long-term, to make it to the next generation, if they have children that are interested, if you get up to about 10 stores, you're going to be diversified in terms of product. You'll be able to hire an excellent CFO, an excellent HR person, IT person, fixed ops trainers, variable ops trainers to support all your stores. And then you're moving from managing people to managing capital. Where should you invest to protect your business and maximize the value long-term? What's the benefit of all this? You prevent the decline. That's the ripe to rotting. You grow your cash flow. You grow your enterprise value. And so what we see, the next wave of consolidation is fewer caretakers, where you just operate what you have and you're satisfied with that, to people evolving to being more empire building for some people, the Morgans of the world, but for others to go from 2 stores to 10 stores, that's a significant transformation. And you have, in my opinion, a rock solid business at that point. Any questions? I've kind of run over my time here. Yes, sir.
That one pattern where you showed an entity deal of $500 million, was that just blue sky alone, or did that include real estate?
That included real estate as well. Yeah, I don't know that I think some of those facilities were leased. Like I think Longo Toyota is a lease. I'm not positive, but I believe that. So it's mostly blue sky.
Second follow-up, totally different subject. You didn't mention anything today about Hyundai.
Yeah.
Heard some positive about Kia, their cousins.
think Hyundai is a more challenging franchise for many. Some people are in the Hyundai camp, they're in the tent, and Hyundai wants to see those retailers have more stores within a region. That makes it a little more difficult to acquire a Hyundai store if you're not one of the fair-haired dealers. In fact, Hyundai might not want you. And so I think for some dealers, it's a little bit spikier to get into. They maybe don't want to go through the effort of buying a Hyundai store and being rejected. I think some Hyundai dealers are not sure, is the inventory allocation system fair? It's just a more challenging factory to work with. Nasser mentioned before, one reason why he likes Kia is because he feels like the relationship between the dealer and the factory is friendly and supportive. And I think Hyundai does have a lot of dealers that feel supported, but there are enough dealers that feel unsupported that we have it valued slightly less. So if you're an existing dealer in good standing, you should buy more Hyundai stores because you're going to get the product you want. If you're not a Hyundai dealer today, it may be harder a franchise to enter than Kia, for instance. I think I'm out of time, but I want to thank everybody again for coming, and Ally, again, please forgive me for not mentioning you sooner. What do we have next, folks?